Hi, everybody. This is David Blain, CEO of BlueSky Wealth Advisors. I wanted to make a video today to talk a little bit about selling, selling investments. And I was going to do this the beginning of the year, as you probably know if you're paying attention. The markets, stock market, bond market have started off 2022. It's been a little rough. Declines in all those markets, and then of course we had the Russian invasion of Ukraine. Kind of wanted to see how that played out. I made a separate video on the impact of that. If you haven't seen that, head on over to our website, YouTube channel to check that out. But I wanted to talk a little bit about selling because as the markets declined this year and then the Russian invasion of Ukraine, people are saying, hey, should we sell? What should we do? And so I thought it would be useful just to kind of go through my philosophy of the way we view investing, selling, those type of things, so that hopefully you'll get a better understanding of the way we view long-term investing and make you a better investor, whether you're doing this yourself or a client of Blue Sky. Hopefully this will be helpful. So number one, you've probably heard the familiar saying that you're supposed to buy low and sell high. And while I love simplifying things, that simplification, there's a lot of detail behind that concept of buy low and sell high. And I think one thing that I like to talk about when investing, whether you're talking about stocks, bonds, real estate, gold, Bitcoin, whatever it is, one thing that comes into play when you're thinking about selling is what I call liquidity. Heck, this even applies to cars. Look at what's happening in the auto market today. Is the shortage of automobiles is driving the price one way or the other. And that's the same in all markets. The liquidity, the ability to quickly convert either cash to a product or a stock, or the opposite, the ability to quickly convert a product, stock, whatever investment to cash is liquidity. How liquid is it? How quickly can you convert what you have, either the cash or the investment, to the opposite, the investment or the cash? Usually it's pretty easy to convert the cash to the investment. However, in times of scarcity, like if you want to invest in a car or buy a house or something like that, that's not always the case. And so liquidity is a very important concept as we talk about investing, buying, selling, holding, things like that. And so when you're a long-term investor, as we are at Blue Sky, and hopefully all of our clients view it that way, the liquidity is really our friend because we don't have to sell anything. We don't have to buy anything. We can patiently wait until the time at which we want to. If you're a short-term trader, or you need money now, or you need to do something now, people that, they have this intensity, I got to do it now. Or if you're a professional manager and you got to hit those quarterly numbers, you have to do it now. And so liquidity becomes a big, big factor. And it affects the ability for success. For a long-term investor, someone that's investing for a number of years, for retirement, for charity, for their kids to inherit, for college, for their 2-year-old. Long term, we have the advantage, and we need to use that advantage. And so when there's liquidity crunches, we stay away. When markets are going crazy and there's liquidity crises, just wait. It will solve itself at some point. And so that allows us to avoid excessive trading. When everyone else worries about what's going to happen in the next month or week, with this Russian invasion of Ukraine. Once again, as I said in my video about Ukraine, it is a human tragedy. And I wish there was something that we could do to stop it immediately. And I don't want to minimize the plight of the individuals that have lost their livelihood, their homes, their businesses, their country is under assault. But the reality is, from a long-term perspective, it will subside. Japan, our sworn enemy in World War II, is one of our best partners today. And so the ability to be patient and take a long-term perspective. Now you may say, well, I don't have a long-term perspective. Okay, well then we need to choose investments that don't require a lot of liquidity or don't have a lot of volatility. But one of the hardest things to do is when you find an investment or you have an investment that has the opportunity to grow and compound over a long period of time, is to hold on to it. And that's what we have with the ability to invest in liquid markets such as stock market, bond market, especially stocks or real estate, things like that. These type of assets have been around for centuries. They may end tomorrow. I don't think so. That's not a highly likely outcome that all of a sudden tomorrow the global stock market is worth nothing. It is possible theoretically, but not very likely. And so taking the long view of investing is a real advantage. And holding on to those investments through good times and bad. I think most of you are familiar with Amazon. I think everybody's bought something probably from Amazon at this point. Amazon went to market, it was back in 1998 for like $5 a share. Did you know that it went up like 20 times in the first couple of years, but by 2001, so the 2001 recession, it was back down to $6 a share. It had lost 93% of its value. And so who would have held on to that whole time? I can tell you, not many people. Jeff Bezos did, the owner of Amazon, but not many other people are going to hold it through that type of thing. And so we want to talk about selling. Why would you sell? The two most common reasons people sell are because they're up a lot. Oh gosh, it went up a lot. I want to take some profits. Remember, you've heard that. Nobody ever went broke taking a profit. Or number two, because it's down. Oh my gosh, it's down. I don't want to lose any more money. We got to sell. So those are two very common reasons that you hear for people selling. Of course, the reason that you should sell is because you need the money for something. You got to pay for your kids' college, or you're retired and you need the money, or you want to buy a new super yacht, or you want to buy a new car or something like that, and you need to sell some of your investments and transition it, purchase something that you need. But in terms of investing, you hear a lot of people that want to sell because it's up or sell because it's down. And when they want to sell, it's because they're afraid their profits will go away. And the reality is that's really kind of a shell game, because if they sell and now they have cash, what are they going to do with the money? If they're just going to hold on to it, then they may miss out on an upswing. So just selling because something has gone up is not necessarily a good reason. It doesn't make sense to sell just because things went up. Now, if something went up and it's way overvalued and its prospects are dim going into the future, okay, that may be a legitimate reason based on the fundamentals of the company, of the market, that you want to sell and get out of that market. But you have to have something else to get into. We'll come back to that in a moment. But the second thing you hear a lot of times is people sell because it's down. Oh, I don't want to lose any more money. And they worry about letting those losses compound. Now, if you did your homework and you bought a good investment, if you didn't speculate on something, then you shouldn't worry about that. If you're buying the entire US stock market or the entire global stock market, then you shouldn't worry about it going to zero. That's not a likely outcome. And so any short-term decline in the market is a really poor reason to sell something. And so really, when you think of those two dichotomies, oh, I want to sell because it's up, or I want to sell because it's down. Really, the smart investors, smart money, is you're taking advantage of people at those extremes, people that are selling really good investments just because they went up, or buying good investments just because they went down. And that's where the patient long-term investor can make out. Look at the rise of passive index investing, like we do here. We buy ETFs, we buy the market. We don't try to pick and choose different companies or or this is going to outperform that. And why is that? It's because the evidence shows that amateur investors and professional investors alike routinely fail to outperform the market as a whole. Okay, so when should investors sell? What is a good time to sell something? And if you shouldn't sell because it went up and you shouldn't sell because it went down, is it ever right to sell? And as I mentioned already, one legitimate reason is you need the money. You need a new car. Your kids are going to college. You need food. You're retired. You don't have a job. You want to buy a new Ferrari or whatever. So the legitimate reason, selling because you need the money. You need to convert that investment to cash to go purchase something. The other main reason, and what I consider the only legitimate reason to sell, is when the prospects for that investment are inferior to an alternative investment. And what do I mean by that? For example, right now in the world, as we look at the global marketplace, the prospects for U.S. large technology stocks, which have gone up so much in the past, are relatively overvalued, is probably a little bit worse than some other types of investments, small caps, foreign companies that have not appreciated so much. And so it makes sense to take some of those investments and rotate them to other investments that have a better long-term perspective. What we don't do is get out of the market completely. As I already said, that is never, no one has ever been able to do that consistently and reliably over a long period of time. One of my favorite things, Charlie Munger, if you think about it, Charlie Munger, who's Warren Buffett's partner, had some things to say. And you have to actually make 3 decisions. So if you decide to sell out of an investment and go to cash, A, the decline in the market that you anticipated happening has to happen. So that's one thing that has to be right. You have to time that right. Number 2, you have to pick what you're going to do with that money while it's not in the market. You can put it in cash, put it in bonds, put it in Bitcoin. What do you do with that money? And number 3 is you have to decide when to get back in. And so just nobody has been able to consistently and reliably do that very well over long periods of time. And so if you make the wrong decision and you get out, you miss the entire gain. And I don't like overemphasizing this, but the reality is the market has very lumpy returns. And what does that mean? It means that most of the time it just sort of meanders, but then most of the gains are made in very short spurts. And the data shows that if you miss, the top 10 or 20 days out of any given year, you miss almost all the return in that year. So the other 240 trading days of the year, the market does nothing. It goes up, it goes down, it goes up, it goes down. But somewhere in there, there's a burst of activity, a burst of growth that accounts for almost the entire return of the year. The same could really be said for years. The average return of the market, depending on what market you're talking about, 7, 8, 9, 10%, something like that. It very, if ever, hits the average. It's always, a lot of returns for the past couple of years. We've had really robust returns for 3, 4 years in a row. And then you're going to have some negative years probably, or some mediocre years. But it's not a consistent annualized return. And so you have to have that time in the market to be successful. Also, along with that concept is diversifying. So when another reason to sell is if your position gets too large. We don't want to have someone that comes in that has a one stock portfolio that accounts for 90% of their wealth. That is a good case of where we want to sell. It's too much risk in one particular security. And that's a judgment call. There's no hard and fast rules behind this. I tell the little story all the time. I'm an engineer kind of guy. I love data. I love numbers. And one of the hardest things that I had to do in finance, at least in financial advising, financial planning, it's a lot of numbers, but it's actually more judgment than it is numbers, because a lot of this stuff, it's not science. You know, in engineering, we studied the laws of thermodynamics. We studied the laws of mechanics. There are laws of nature that if you follow them, the plane will fly. There are no laws of finance. There are theories. There's monetary theories. There's investment theories, but there are no laws, or there are very few, or they're very simplistic. But there are no laws that say you have to make money. And in fact, my theory of investing is, why should you be able to make 8%, 9% on your money for no risk? You have to give something up for that. If I said, hey, I'll give you, you give me some money and I'll pay you back the exact same amount in 10 years. You give me $1 million, I'll give you $1 million back in 10 years. Well, nobody's going to do that because you've given up the use of that money for all that time. And so you have to be compensated for that return. So when you make an investment into, an investment into stocks or real estate or something like that, you're giving up the use of that money and you expect a return for that money when you get it back, if you draw it back. And what is the price that you have to pay? And I'm telling you, in the stock market where you don't have to do anything except click a button and buy the shares of stock, the price that you pay is the emotional turmoil of watching it go up and down. And if you can extract yourself from that, it becomes a lot easier. Commit to being a long-term investor. Don't look at it all the time. Have a plan for your short-term needs. And then investing becomes much more calm. You're not worried about it. It's when people expect the markets to do something that it can't, that they become concerned about it. And understanding that the price you have to pay is volatility, is watching it go up and down. That's what enables you to make the money that you make. If there was no price to pay, you wouldn't make 8, 9, 10% over the long term. You would get nothing for your money. And so that's kind of important to remember. Okay, so selling, just to kind of recap, I wanted to address this because every time the market kind of starts going down, I get questions about, hey, should we sell? So number one, we don't want to just sell because things went up. Number two, we don't want to sell just because things went down. We want to sell when there's a need for the money. So the individual needs some money to do something. Or three, when the prospects for some other asset class are better than the current one that we own. And that decision requires judgment. There's no mechanical, there's no algorithm, there's no formula that's going to get that right every time. It requires judgment, study, experience, those type of things. And it's not perfect. And so our philosophy on that is to make those type of changes very slowly, very deliberately, and not very often. And I'll kind of summarize here with something from Warren Buffett. Warren Buffett said you only get so many decisions in your investing lifetime. And if you're making decisions on a day-to-day basis, most of them will come out bad. And that you should reserve those big decisions for sparing decisions when you have a high degree of confidence that you're right. And so that's the approach that we take when deciding to sell and switch investments. A high degree of confidence that we're right, that the alternative investment that we're moving to has better prospects for the future. So if you have any questions on our selling philosophy or how we approach the management of portfolios, please let us know, get in touch with us. And I hope you enjoyed learning a little bit about our selling philosophy.